man, it's time to do another Q&A video.
Hey everyone, Ryan Bolton here, local mortgage expert, ryanbolton.com, answering more questions I found on the internet about helping you buy or sell or do mortgage loans. I really enjoy these Q&As. I hope you get some information out of them. And well, just jump in, see how many questions we can answer today. So the first one I found here comes up a lot, and it talks about hidden fees on doing a mortgage loan. This particular question asks about FHA hidden fees. And I really want to reiterate the fact there really isn't hidden fees as there was maybe in the years past, because we have to send out a loan estimate whenever we get an application. There's 8 things that trigger an application. Once that gets triggered by law, we have to send out a loan estimate within 3 business days. That loan estimate is compared to a final closing disclosure at least 3 days before you go to sign. There's a comparison to make sure that those fees did not change dramatically. Some fees can't change at all. So once we quote the fee, they cannot increase. There's other fees that can change up to 10%. This would be third-party fees, maybe the appraisal, title company, home insurance, some things like that do allow a little bit more of a tolerance, but almost all the templates we use are now designed to be a little more worst case on the loan estimate and then finalized on the closing disclosure. But that closing disclosure will do a comparison to what you were quoted to what you're actually getting, and almost every time it goes down, and in many cases, it can't even go up. So there really isn't hidden fees. We have to disclose everything up front. And sometimes this is before we even have your income, your assets, before you even have an appraisal back. So a lot of times that loan estimate gets issued a few times as new information comes into the file. But no matter what, at least 3 days before signing, there has to be that closing disclosure, which really nails down all the final numbers, give you 3 days before you even walk into the title company to know exactly the loan that you're actually getting. Now, when it comes to FHA, they have a little different way that they do their financing. Typically, FHA is 96.5% or 3.5% down. Then FHA adds an upfront mortgage insurance premium back on top of the loan. So this gets financed. So the actual loan amount is higher than 96.5%. Then they have a monthly mortgage insurance premium as well. So they charge a little bit upfront and then a little bit each month. So that isn't really a hidden fee. It's just financed on top of the loan. So the loan amounts are always a little bit different. It's not exactly 96.5%. That upfront mortgage insurance premium is typically 1.85%. So that gets added to that base loan amount. So that's what you're actually financing. So you're not having to bring that extra money in on top of all the other closing costs, but it is a part of getting an FHA loan. FHA loans are great with minimum down, first-time home buyers, and credit scores that might be a little bit lower or lack of credit history, just a first-time home buyer type program. So, excuse me. So it is something where if you have a higher credit score or have a little bit more money to work with, you might want to take a look at the HomeReady or HomePossible loan programs, because they don't have that upfront mortgage insurance premium and the monthly insurance can be cheaper, or you can even buy it out completely where you don't have the mortgage insurance. So give me a call. Check out my website at ryanbolton.com if you're looking to buy a home in Utah or Nevada, and I can break down the benefits and disadvantages of all these different loan programs. So let's see what other questions we can find real quick. Let's see. Can I get a home loan if you have an FHA loan and your credit is below a 620? Yes, but typically lenders want to see more money down. I know lenders go down to a 580 credit score, but they require 10% down. So the answer is yes, but most of the time we can get your credit score up. There's little tricks we can do, maybe some disputing, pay down some credit cards, build some credit lines. If we get you to 660, that really helps certain loan programs open up, or at least the 620. That's kind of the magic number, is at least 620. If you're below that, yes, you can, but you're going to pay for an interest rate and down payment. Where sometimes it's better off, instead of putting that extra money down, use that money to dispute or pay off collections or negotiate on settlements and stuff like that. So having a little more time to work on the credit is better than just getting any loan that you can get. So it is something where work on the credit might be better than just getting the loan that's available for a lower credit score. But it's a crazy little tricks you can do to get that score up over at least a 620. Let's see. Let me get to another screen here. I hope you enjoyed these videos. Please like, subscribe, comment. If you have any questions, I can add those to future videos. But here is some other one. Looks like there's a bunch of FHA. Let's see what else we got. What are the tax benefits of taking out a home equity loan? So any mortgage interest is potentially tax deductible. You want to talk to your CPA, but you have they've changed how much you can write off with mortgage interest. So if you have a ton of properties, or you have a certain dollar amount, or certain income, they start to restrict how much of it you can write off. But a home equity loan is still a mortgage loan against the property. That interest can be tax deductible if you qualify. There's also no disadvantage to taxes by doing a home equity line of credit. I've had a bunch of people think, well, if I do a home equity line of credit, pull out 50 grand, is that tax? Is that income? The answer is no, it is a loan. So there isn't any tax penalties for pulling that out. There's only some tax benefits by the interest you're paying on it. The only time you can have an issue there is there can be capital gains if you sell the home, even if you pull out that second mortgage money. But the tax benefits are really the same as that first mortgage. You can write off the interest if you qualify. Let's see. How much of a home loan can I get with a 720 credit score? Credit score is a big factor on determining the interest rate you get and what type of loan programs open up. But it doesn't mean just because you have a 720 score suddenly means you can afford more home. Your debt ratio is really a bigger factor on how much home you can qualify for. But having a higher score makes the rate better, which helps you afford more for the same monthly payment. So credit score is important, but just the credit score doesn't determine how much you qualify for. It's a combination of credit score to determine rate, and the bigger factor by far is income verification. Most loan programs want to be under 45% of your verifiable monthly income. If you're self-employed, there's different calculations versus if you're W-2, but it is something where whatever that number is per month, they want to take 45% or less to debt service. I have seen times where it'll go higher. I've seen as high as 55%, depending on how much income, the type of loan program, credit scores, things of that nature. But debt ratio factors in way more to how much you'll qualify for than just the credit score alone. All right, what else we got here? Let's see. What does it mean when a home loan is pending for more than 6 months? I don't know of a home loan that would pend that long. Maybe a home listing, maybe something that's on the market's been pending for that long. Maybe it's just because of a lease agreement. So I've seen sometimes where it's under like a lease option. So they'll just leave it as pending and not actually show that it's closed yet because it's a lease option. But as far as a home loan pending for that long, I think it might just mean that the home sells. So not knowing the full context of that question, but that's generally when I see a home that's been sitting there or they just haven't updated it. Sometimes that happens. It just gets missed, a clerical thing, and they forgot to show that it closed. But most common I've seen it's some sort of lease agreement or lease option to buy that they just leave it pending because they have 6 months or 12 months to execute that offer. So I would say that's more common to that type of situation. Let's see. How does one receive a home loan amount after getting approved for it? So that's part of the pre-approval process. How does one receive the home loan amount after getting approved for it? So it can be a little bit flexible because it's something where the income might change, rates might change a little bit, but generally the pre-approval will give us a range of kind of what you'll approve for. Plus, some homes have an HOA. So maybe you're approved for, say, $400,000 without an HOA, but then there's a $200 HOA. Maybe that lowers that amount a little bit. So part of the pre-approval is to kind of nail down a general idea until we find the house you want to put a specific offer on. Then we can tighten up those numbers and make sure you still qualify, whether rates change or the property changes, income changes, paying off debts. There's a lot of things that can kind of change that can adjust that loan amount. But that's part of that pre-approval process, is to give you kind of a base range. Then once you find a home, we fine tune and kind of tighten up the numbers once we find a home. Is $10,000 an acceptable down payment on a $300,000 home? So there's really no benefit to putting a dollar amount down. It's more of a percentage down, but you also have closing costs that are typically on top of that. Now, you can ask the seller to include that as part of the sales price, so you only have to do your down payment, but there's really no benefit to, say, putting 6% down or 4.5% down. The tiers are 3, 3.5, 5, and 10, and it can go down from there, but we're talking about $10,000 on $300,000. So you're better off in that case to put the minimum down and then take the money you have left over to either cover the closing costs, buy down your interest rate, or use it just for moving expenses. Maybe it's better to pay off or pay down another loan to help you qualify for more home. So there isn't just I have 20 grand, I want to put 20 grand down. A lot of times it's like, well, let's maximize that money to make sure you're getting the best rates and terms and not just putting extra money down that could be better served somewhere else. I mean, $2,000 on a mortgage isn't going to go very far. The $2,000 maybe paying down a car to reduce its payment, maybe paying off a debt, or keep it in savings, emergency fund. Make sure that you have a little bit of reserve if something happens with your job or health or something like that. That $2,000 in the bank or in other ways usually goes a lot further than putting it down towards the mortgage. So is $10,000 acceptable? Sure. But I would say because of the 10,000 versus 300,000, you're probably better off to put less money down and have the rest of the money for closing costs. Let's see. What's the best way? Let's see. Is there any way to get rid of a high interest home loan without refinancing or selling? No. That loan is tied to the property until it's paid off, whether it's a refinance, excuse me, or whether you sell the property. So short answer is no. But if you do have a high interest rate on the loan, that's what the refinance is for. So it only benefits you to get rid of that high interest rate if you're going to keep the home by doing a refinance. Now, many refinances will include the closing costs as part of the new loan amount. So you don't have to bring that extra money to the table. And many times you'll recoup the investment within 6 months to a year, depending on that separation, depending on the rate you have versus the rate you're going down to. So I wouldn't be afraid of a refinance, but there really isn't any other way to do it to lower the rate. The rate's the rate. That's the loan that you have on the property until it sells or refinances. That's what those programs are designed to do. Let's see. Can you renegotiate your mortgage term after getting approved for a new home loan? Short answer, yes, because once you're approved, until you're closed, the loan's not done yet. You can still negotiate the terms. You can still negotiate pricing. A lot of it's set by the market, but you absolutely can say, hey, I want to buy down the rate, or I want to change the program to a 30-year or a 15-year, an ARM or something like that. But absolutely, until it's done and done, just because you got an approval at the beginning doesn't mean new information doesn't come in. Changes to the situation allow you to renegotiate. So absolutely, until you actually sign the note and close on that property, everything's kind of up for grabs in a sense. Now, you don't want to wait till the last second. You want to try to get that nailed down as you're going through the final stages of underwriting. But absolutely, just because you started at a certain loan amount or a certain down payment or rate or program or term and something changes and you want to look at other options, absolutely. There's nothing that says you can't revisit that. But again, I would just make sure that it's not too late in the ball game, because you might jeopardize your earnest money or just go back through underwriting. I mean, that's part of the job as a loan officer, is give you all those options so that we can kind of pick the one you're most leaning towards. But nothing is set in stone until you actually sign the paperwork. Let's see. What are the benefits and drawbacks of refinancing a home loan when interest rates fall? That's just going to be bonus or gravy. What if interest rates don't? What if they just stay the same? What if the rate today is the best we're going to see in the next 10 years? What if rates go to 2% next year? I mean, the whole idea of a refinance is if it makes sense based on the payment savings and how long you plan on keeping the home. I think that's probably the most crucial part. If you're only going to keep the home another year, if you're going to relocate or upgrade or downgrade, you got kids graduating or you're going to be relocating, then maybe the refinance doesn't make as much sense. But if you're going to keep the home at least 3 years, almost every refinance will make sense if you're saving enough money. But I wouldn't say right now buying a home with the intention you're going to refinance, because if you want to make sure your payment's comfortable today. And if it does get lower or you're able to refinance, that's just bonus. That's just gravy. That's just benefit of being a homeowner over the course of time. But it isn't something where I would go into a home right now stretching myself too far, having too high of a payment, thinking that I'll be able to refinance, and that's the only way I'll be able to keep the home. You don't want to go into it with that mentality. You want to go into it with, I can afford this home, I can afford this payment, it fits my needs. It's locking in the payment where rent can change so much. So it is something where I think it's really important to be comfortable with the payment you have now. If it gets better with a refinance, that's a bonus. That's a gravy. Let's see. Can I have a VA loan with student loans? Yes. Student loans are going to be an interesting topic. They are constantly looking at guidelines on how to do student loans because of forgiveness or How do they factor the payment when they've been in deferment for so long? So they kind of are changing guidelines with it. But the short answer is yes, you can do a VA loan with student loans unless they're default or have lates and affect your credit score. But there's nothing to say you can't do a loan or mortgage with student loans. The only factor really comes into is debt ratio. Most of the guidelines right now say we have to hit you for what the payment will be if it comes out of deferment. So we have to reach out to the student loan company and say, okay, if the loan was out of deferment, what's the estimated payment? Or we have to go with 1%. Some programs are coming up with 0.5% of the balance, but most of them are around 1% of the balance. Now, every time I've gotten a letter from Nelnet or all the student loan companies out there, usually getting a letter from them is always less than the 1%. So that's usually the better way to go. But if you have a lot of student loan debt and your payment's $1,000 a month, that just has to factor into your debt ratio. So it's really going to lower your buying power until the student loans are resolved or paid off, or a lower payment, or if they're waived. I mean, there's a lot of stuff's going to be happening with student loans over the next few years. But it doesn't prevent you from getting a home loan. It just might make it a little bit harder depending on how much you actually owe and what the payment will be once it comes out of deferment. Let's see. How are we doing on time? We can squeeze one more in here, maybe two more if we get lucky. I hope you enjoy these videos. Please like, subscribe. If there's topics you want me to go a little deeper into, I have other videos on the channel. You can check those out. But please like and subscribe. I really enjoy doing these. I have a lot of fun doing it. And these are just off the cuff. I don't really prep any of these. This is just fun. All right, let's see. How do I get rid of private mortgage insurance on a home equity loan or refinance when using an FHA loan to purchase the new home? Okay, so how do I get rid of private mortgage insurance? With FHA, you can't. Plain and simple. Especially with the minimum down. If you put 10% down on an FHA loan, you can get rid of it after 10 years. But until you sell or refinance that first mortgage, you cannot get rid of the mortgage insurance with FHA. It's just part of that loan. That's why they underwrite it. That's how they do it. You just have to keep the mortgage insurance. So if you add a home equity line of credit on top of that, then essentially you're going to have to refinance the FHA first and the second to remove the FHA loan off of there. So you may want to look at first refinancing the FHA loan, then adding the line of credit on top of that. But it really just comes down to interest rates. My worry is your rate, even with mortgage insurance, is probably a cheaper payment than what you can get today. So it really depends on what interest rate you have on your FHA loan, when you did that loan. So you might not be able to get rid of the mortgage insurance, but honestly, it might still be cheaper with the lower rate and the mortgage insurance than the rates that are available today. But in the future, just a general statement, you want to first look at refinancing the first if you're getting rid of the mortgage insurance, maybe doing a cash out refi on the first mortgage, then adding the line of credit. But line of credits are going to be really popular over the next few years because so many people locked in their interest rate at 3 and 4% on their mortgages. They don't want to jump up to, say, 7% on the bulk of their debt. So I think the second mortgages, lines of credit are going to become really popular because people do have equity. They're still cheaper rates than Visas and credit cards or store cards. So it's still a great way to tap into the equity that you're sitting on without having to touch your first mortgage. But if you're trying to get rid of the mortgage insurance, most cases, especially FHA, you cannot get rid of it, or you can't get rid of it for a long period of time without doing a new refinance. But it might not make sense. Honestly, it might not make sense. If you got a 3% FHA loan, even with the mortgage insurance, your effective rate's probably still 4.25%, and rates are higher. So you might just be stuck with it, but it's still a cheaper housing payment than going through a refinance. So I hope that information is helpful. If you have any questions, again, love to talk with you. If you need help with a home loan, I service the state of Utah and Nevada and would love to earn your business, would love to help you with any scenarios. Go to my website at ryanbolton.com. I have a little scheduler on there, and you can schedule an appointment. We can talk. So I appreciate your time. Again, like and subscribe, and we'll see you next time.